Money loses value when it sits still, and this is one of the most important lessons anyone can learn about finance, especially as a beginner. Most people believe that saving money is the safest thing they can do. They are taught from a young age that putting cash in a bank account equals security. But what they are rarely told is that while their money appears safe, its purchasing power is quietly being eroded every single day. Inflation works in the background, invisible but relentless, increasing the cost of living year after year while the value of idle cash slowly declines. Think about what the same amount of money could buy 10 years ago compared to today. Groceries, fuel, rent, education, healthcare, everything costs more. Yet money sitting in a basic savings account does not grow at the same pace. Even when interest is paid, it is often lower than the inflation rate, meaning the real value of that money is shrinking. This creates a dangerous illusion where people feel financially responsible because they are saving, while in reality they are falling behind without realizing it. When money stays still, it doesn't just lose value, it loses opportunity. Every dollar has the potential to work, to grow, and to compound over time. When it is left unused, that potential is wasted. Time is the most powerful factor in building wealth, and idle money misses out on time. The longer money sits without growth, the harder it becomes to catch up later. This is why starting early matters so much, even with small amounts. It's not about how much money you have, but how long you allow it to work for you. Many beginners avoid investing because they fear losing money. Ironically, by avoiding investment altogether, they guarantee a slow loss instead. Inflation does not announce itself. It doesn't send warnings or headlines tailored to individuals. It simply exists, quietly reducing buying power. This is why understanding money movement is more important than simply holding money. Wealth is not built by accumulation alone. It is built by growth. Another issue with letting money sit still is psychological. When people see money resting in an account, it feels productive even when it isn't. This false sense of progress can delay action for years. People tell themselves they will invest later when they have more money, more knowledge, or more confidence. Meanwhile, inflation keeps moving, markets keep evolving, and opportunities continue to pass by. Waiting often feels safe, but in reality, it carries a cost that compounds just like returns would have. Investing is not about reckless risk or chasing fast profits. It is about protecting money from erosion and giving it a chance to grow alongside the economy. Businesses expand, technology improves, populations grow, and productivity increases over time. Investing allows individuals to participate in that growth instead of watching from the sidelines. When money is invested wisely, it becomes connected to progress rather than trapped by stagnation. Cash still has a role. It provides liquidity, emergency security, and short-term stability. But excess cash sitting idle for long periods serves no purpose other than comfort. Comfort, however, does not build financial independence. Understanding when money should be parked and when it should be put to work is a skill that separates those who struggle financially from those who build long-term security. The fear of investing often comes from misunderstanding. Many beginners imagine investing as complex, risky, or reserved for experts. In reality, the basic concept is simple. Money should either be growing or serving a specific purpose. If it is doing neither, it is slowly losing relevance. This shift in mindset is critical. Once people realize that doing nothing with money is an active decision with real consequences, their perspective changes. Every year that passes without growth increases the pressure on future income. This leads to longer working years, higher stress, and fewer options later in life. Money that grows early reduces the burden later. It creates flexibility, choices, and time. Letting money sit still does the opposite. It pushes responsibility forward and makes future decisions harder and more urgent. Understanding that money loses value when it sits still is not meant to create fear, but awareness. Awareness leads to intentional action. It encourages people to learn, to ask questions, and to take small, calculated steps instead of remaining frozen by uncertainty. The goal is not perfection, but progress. Even modest growth is better than guaranteed decline, and once this principle is understood, money is no longer seen as something to protect at all costs, but as a tool that needs direction, movement, and purpose to remain relevant in an economy that never stops changing. Investing is a skill, not a gamble, and understanding this distinction changes the way people approach money forever. Most beginners associate investing with luck, speculation, or dramatic stories of people winning big or losing everything. These narratives make investing feel like a casino, where outcomes depend on timing, emotion, or insider knowledge. In reality, successful investing has far more in common with learning a craft than placing a bet. It is built on knowledge, discipline, and repeatable decision-making rather than chance. A gamble relies on uncertainty with no control over the outcome. Once the bet is placed, the result is out of your hands. Investing works differently. While no one can predict markets perfectly, investors can influence outcomes through research, diversification, time, and risk management. The more skilled the investor, the more predictable their results become over the long term. This is why experienced investors focus less on short-term movements and more on processes they can control. Skills are developed through learning and practice, and investing is no exception. Understanding basic concepts like assets, risk, returns, compounding, and diversification creates a foundation that reduces emotional decision-making. Beginners often lose money not because markets are unfair, but because they react emotionally to fear and excitement. Skill replaces reaction with reasoning. Instead of panicking during downturns or chasing hype during rallies, skilled investors follow plans built on logic rather than impulse. One of the biggest myths about investing is that you need to be highly intelligent or mathematically gifted to succeed. In truth, patience and consistency matter more than raw intelligence. Many people fail because they overcomplicate decisions or try to outsmart the market. Investing as a skill encourages simplicity. It teaches that doing a few things well over a long period of time produces better results than constantly changing strategies. Another reason investing is often mistaken for gambling is the focus on short-term outcomes. When people judge success based on daily or weekly price movements, investing feels unpredictable. But skills reveal themselves over time, not instantly. Just like learning a language or mastering a sport, progress is gradual. The real measure of investing skill is not how much you make in a month, but how well you manage risk and grow wealth over years. Risk is often misunderstood as danger, when in reality it is something that can be measured and managed. Gamblers seek risk for excitement. Investors manage risk to protect capital. Skill teaches how to balance risk and reward, how to avoid putting everything into one idea, and how to survive inevitable downturns. The goal is not to avoid losses completely, but to make sure no single mistake can cause permanent damage. Investing skill also involves understanding behavior. Markets are driven by human emotions: fear, greed, optimism, and panic. Skilled investors learn to recognize these patterns and avoid being controlled by them. They don't need to predict headlines or trends, they need to control their reactions. This emotional discipline is one of the most valuable skills in investing, and one of the hardest to develop. Consistency is another trait that separates skill from gambling. A gambler looks for one big win. An investor looks for repeatable outcomes. Regular investing, long-term planning, and sticking to a strategy during both good and bad periods require discipline. Skill turns investing into a routine rather than an event.
Over time, this routine compounds into results that appear impressive from the outside, but are simply the outcome of consistency. Learning investing as a skill also removes the fear of starting small. Gamblers feel small amounts are pointless because they want instant rewards. Investors understand that small amounts are training tools. Every dollar invested teaches lessons about patience, volatility, and decision-making. Starting small allows beginners to build confidence and experience without unnecessary risk, reinforcing the idea that investing is a process, not a single moment. When investing is treated as a skill, mistakes become feedback rather than failure. Losses are analyzed, strategies are refined, and knowledge improves. This mindset encourages growth rather than avoidance. People who view investing as gambling often quit after a setback, while those who see it as a skill adjust and continue. Over time, this difference in mindset leads to dramatically different financial outcomes. The most powerful aspect of seeing investing as a skill is that it puts control back in the hands of the individual. Outcomes are no longer left to luck or hope. With education, discipline, and time, investing becomes a tool for building stability and independence rather than a source of stress or uncertainty. This shift in perspective is what allows ordinary people to participate in wealth creation in a structured, intentional way, instead of relying on chance in an environment where patience and preparation consistently outperform excitement and impulse.
Beginners have an advantage, even though it rarely feels that way at the start. Most people assume that experience is everything in investing, and that those who are new are automatically at a disadvantage. In reality, beginners often start in a stronger position than they realize because they are not weighed down by habits, biases, or past mistakes. They are approaching investing with fresh eyes, and that openness can be a powerful asset when used correctly. One of the biggest advantages beginners have is the absence of overconfidence. Experienced investors sometimes believe they know more than they actually do, which can lead to unnecessary risks and emotional decisions. Beginners, on the other hand, tend to be more cautious. They ask questions, seek guidance, and are more likely to follow basic principles. This caution, when paired with learning, often leads to better long-term behavior than reckless confidence. Beginners also have the benefit of starting in a world where information is more accessible than ever. Educational content, tools, and platforms that once required professional access are now available to anyone with an internet connection. This levels the playing field significantly. While experienced investors may rely on outdated strategies or personal opinions formed years ago, beginners can learn modern approaches built on data, diversification, and long-term thinking from the very beginning. Another major advantage is flexibility. Beginners are not emotionally attached to specific assets, strategies, or beliefs. They're not trying to recover from previous losses or defend past decisions. This makes it easier for them to adapt, learn, and adjust their approach as they gain knowledge. They can build a strategy based on logic rather than ego, which is something many experienced investors struggle to do. Beginners also benefit from time, even if they don't feel wealthy yet. Time is more important than starting capital, and those who begin early have a significant edge. Small amounts invested consistently over a long period can outperform larger sums invested later. Beginners who understand this early can focus on building habits rather than chasing results, allowing compounding to work quietly in the background. There is also an emotional advantage to being new. Beginners haven't yet experienced major market crashes or losses that can create fear-based decision-making. While caution is healthy, fear rooted in past trauma can prevent rational action. Beginners can learn to expect volatility as a normal part of investing rather than something to panic over. When educated properly, they can enter the market with realistic expectations instead of emotional reactions. Another overlooked advantage is that beginners are more likely to follow simple strategies. Simplicity is often more effective than complexity in investing.
Many experienced investors lose returns by constantly adjusting their portfolios, chasing trends, or trying to time the market. Beginners who stick to diversified, long-term strategies often outperform because they are not trying to outsmart the system. Beginners are also in the best position to build discipline early. Habits formed at the beginning tend to stick. Learning to invest regularly, ignore noise, and stay patient creates a foundation that supports long-term success. It is much harder to unlearn bad habits later than it is to build good ones from the start. This makes the early stages of investing especially important. The beginner mindset encourages learning rather than proving something. There is no pressure to appear knowledgeable or successful. This allows room for mistakes without ego getting in the way. Each decision becomes a lesson rather than a reflection of self-worth. Over time, this mindset leads to steady improvement and confidence grounded in understanding rather than luck. Being a beginner also means expectations are lower, which reduces stress. There's no need to beat the market or impress anyone. The goal is progress, not perfection. This removes unnecessary pressure and allows investing to become a long-term process rather than a short-term obsession. Stress often leads to poor decisions, and beginners who approach investing calmly are less likely to sabotage themselves. Many people delay investing because they believe they need more knowledge or more money before starting. In reality, beginners who start with what they have and learn along the way gain experience that others postpone for years. That early experience compounds just like money does. Each year of learning, observing, and staying invested builds confidence and understanding that cannot be rushed. The true advantage of being a beginner is the opportunity to start correctly. There's no need to undo mistakes, recover losses, or rebuild confidence. With the right mindset, beginners can focus on fundamentals, patience, and consistency from day one. They can build a relationship with money based on logic and long-term thinking, instead of emotion and urgency, allowing growth to happen naturally while avoiding many of the traps that catch those who started without guidance or self-awareness.
Time matters more than timing, and this idea challenges one of the most common mistakes people make when they start investing. Many beginners believe success depends on finding the perfect moment to enter the market. They wait for prices to drop, for news to improve, or for certainty to appear. This waiting creates the illusion of control, but in reality, it often leads to missed opportunities and unnecessary hesitation. Markets move constantly, and perfect timing is something even professionals cannot consistently achieve. Timing assumes that it is possible to predict short-term market movements with accuracy. This belief is reinforced by headlines, social media opinions, and dramatic success stories that highlight people who bought at the bottom or sold at the top. What is rarely shown are the countless failed attempts, missed gains, and emotional stress caused by trying to time the market. Time in the market, not timing the market, is what allows compounding to work effectively. Compounding depends on duration. The longer money is invested, the more opportunities it has to grow on top of previous growth. Delaying investment in search of the perfect moment shortens this time frame. Even small delays can have a significant impact over decades. A few years of waiting at the beginning can reduce potential outcomes far more than a few bad entry points spread over time. Markets reward participation, not prediction. Historically, long-term investors who stayed invested through ups and downs benefited from overall economic growth. Those who waited on the sidelines often missed the strongest recovery periods, which tend to happen quickly and unexpectedly. Missing just a few of the best days in the market can drastically reduce long-term returns, and those days often occur during periods of fear when most people are waiting. Time also helps smooth out volatility. Short-term fluctuations feel dramatic, but over longer periods they become less significant. What looks like chaos over days or months often appears like a steady upward trend over years.
Time reduces the impact of poor timing decisions because multiple market cycles average out results. This is why consistent investing often outperforms lump sum attempts based on market predictions. Another reason time matters more than timing is emotional management. Trying to time the market increases stress and anxiety. Every decision feels urgent and high stakes. This pressure leads to second-guessing and emotional reactions that hurt performance. Long-term investing shifts focus away from constant decision-making and toward patience. It removes the need to react to every headline or market movement. Regular investing reinforces this principle. By investing consistently over time, investors automatically buy at different price levels. This approach removes the need to guess the right moment and instead turns volatility into an advantage. When prices are lower, the same investment buys more. When prices are higher, existing investments grow in value. Over time, this balances out and builds discipline. The obsession with timing often comes from fear of loss. People want to avoid seeing their investments drop in value. While this fear is understandable, it ignores the reality that short-term declines are normal. Time transforms temporary losses into recoverable phases. Investors who accept this are less likely to panic and more likely to stay committed to their strategy. Economic growth is driven by innovation, productivity, and human progress, all of which unfold over long periods. Investing aligns money with these forces. Trying to time short-term movements disconnects money from long-term growth. Time allows investments to benefit from expansion, reinvestment, and adaptation across different environments. Waiting for certainty is another form of timing that works against investors. Certainty usually appears after opportunities have passed. When markets feel safe, prices often reflect that confidence. By the time conditions look ideal, much of the growth has already occurred. Time rewards those who accept uncertainty early and stay invested through it. The most successful investors are rarely those who made perfect entries. They are the ones who started early, stayed consistent, and allowed time to do the heavy lifting. Their results come from endurance rather than precision. Time compensates for mistakes, softens volatility, and multiplies discipline. Understanding that time matters more than timing shifts focus from control to commitment. It encourages action over hesitation and patience over prediction. Instead of asking when to invest, the better question becomes how long investments can be allowed to grow. This mindset removes pressure, simplifies decisions, and aligns behavior with how markets actually work rather than how people wish they worked.
Consistency beats quick wins, especially in investing, where outcomes are shaped by behavior more than brilliance. Many people enter the world of investing chasing fast results. They look for the next big opportunity, the asset that will multiply overnight, or the strategy that promises immediate success. While these stories are exciting, they are not how sustainable wealth is built. Quick wins are unpredictable and rare, while consistency is reliable and repeatable. Consistency works because it aligns with how markets and compounding function. Small, regular actions taken over long periods create results that appear extraordinary only in hindsight. Investing consistently means contributing regularly, staying invested during different market conditions, and resisting the urge to constantly change direction. This approach removes the pressure to be right all the time and replaces it with the discipline to show up repeatedly. Quick wins create unrealistic expectations. When people experience early success, they often attribute it to skill rather than luck. This can lead to overconfidence, increased risk-taking, and emotional decision-making. When the inevitable losses occur, the disappointment feels personal and discouraging. Consistency, on the other hand, sets realistic expectations. It focuses on progress rather than perfection and accepts that growth happens unevenly.
Another problem with chasing quick wins is that it encourages short-term thinking. Decisions are made based on what might happen next week or next month instead of what is likely to happen over years. This mindset increases stress and leads to frequent buying and selling, which often reduces returns due to poor timing, fees, and emotional reactions. Consistent investing reduces these frictions by minimizing unnecessary decisions. Consistency also builds discipline, which is one of the most valuable traits in investing. Discipline keeps investors committed to their strategy, even when emotions suggest otherwise. It helps them continue investing during market downturns, when fear is high and prices are low. These periods, while uncomfortable, are often the most important for long-term growth. Consistent behavior during difficult times is what separates long-term investors from short-term speculators. Regular investing turns volatility into an advantage. When investments are made consistently, market fluctuations work in favor of the investor. Lower prices allow for the purchase of more assets, while higher prices increase the value of existing holdings. This process reduces the need to predict market movements and allows growth to occur naturally over time. Quick wins often rely on timing, speculation, or concentrated bets. These approaches increase the risk of significant losses. While they can produce dramatic gains, they can also erase progress just as quickly. Consistency spreads risk across time and reduces the impact of any single decision. This makes outcomes more stable and predictable over the long term. Another advantage of consistency is that it simplifies investing. Instead of constantly searching for opportunities, investors follow a routine. This routine reduces mental fatigue and emotional involvement. Investing becomes a habit rather than an event. Habits are easier to maintain than motivation, especially over long periods. Consistency also aligns with real life. Income is usually earned regularly, not in large, unpredictable amounts. Matching investing behavior to income patterns makes it more sustainable. This approach encourages people to invest what they can afford without disrupting their lifestyle. Over time, these manageable contributions accumulate into significant sums. Chasing quick wins can also create a cycle of comparison. People measure their progress against others who appear to be succeeding faster. This comparison fuels impatience and dissatisfaction, leading to impulsive decisions. Consistency shifts focus inward toward personal goals and long-term progress. It reduces the influence of external noise and trends. The psychological benefits of consistency are often underestimated. Knowing that progress is being made regularly builds confidence and reduces anxiety. Even during periods when markets are stagnant or declining, consistent investors can take comfort in the fact that they are following a proven process. This emotional stability supports better decision-making. Over time, consistent investing compounds not only money, but behavior. Each repeated action reinforces discipline, patience, and trust in the process. These traits become automatic, reducing the likelihood of self-sabotage. The result is steady progress that may not be dramatic in the short term, but becomes powerful when viewed over years or decades. Quick wins may capture attention, but they rarely create lasting results. They depend on conditions that cannot be controlled and outcomes that cannot be repeated reliably. Consistency depends on actions within control. Showing up, staying invested, and sticking to a plan may not feel exciting, but it is effective. This is why, in the long run, consistency quietly outperforms excitement, patience outperforms urgency, and steady effort outperforms short bursts of luck.
Knowledge creates financial freedom, not because information alone makes people wealthy, but because understanding changes behavior. Most financial struggles are not caused by a lack of income, but by a lack of clarity about how money works.
Without knowledge, people rely on guesswork, advice from unreliable sources, or habits passed down without question. This leads to repeated mistakes and a cycle of financial stress that feels difficult to escape. Financial knowledge gives people control. It allows them to make decisions intentionally rather than reactively. When someone understands concepts like cash flow, assets, liabilities, risk, and compounding, money becomes predictable instead of overwhelming. This predictability reduces fear and replaces it with confidence. Confidence is not about knowing everything, but about knowing enough to act without hesitation or panic. One of the most powerful aspects of knowledge is that it reduces dependence. People who lack financial understanding often depend on employers, lenders, or advisors to make decisions for them. While guidance can be helpful, blind dependence limits freedom. Knowledge allows individuals to evaluate options, ask better questions, and recognize when advice aligns with their goals or serves someone else's interests. Financial knowledge creates awareness. It helps people recognize unnecessary fees, unrealistic promises, and hidden risks. This protection alone can have a massive impact on long-term outcomes. Another way knowledge creates freedom is by expanding choices. When people understand how money grows and how risks are managed, they can choose paths that align with their values. They can decide whether to prioritize stability, growth, flexibility, or time. Money stops being a constraint and starts becoming a tool. This shift changes how people view work, spending, and long-term planning. Knowledge also transforms mistakes into lessons. Without understanding, losses feel random and discouraging. With knowledge, they become feedback. Each outcome provides information that improves future decisions. This learning loop accelerates progress and builds resilience. Financial freedom is not the absence of setbacks, but the ability to recover and adapt. The Internet has made information widely available, but access alone is not enough. True knowledge comes from understanding principles, not memorizing tips. Trends change, markets evolve, and strategies become outdated. Principles endure. Learning how to think about money is more valuable than learning what to buy. This mindset allows people to adapt regardless of economic conditions. Knowledge also encourages long-term thinking. Short-term rewards often come at the expense of long-term stability. Financial education highlights trade-offs and consequences. It helps people delay gratification and make decisions that benefit their future selves. This ability to think ahead is one of the defining traits of financial independence. As knowledge grows, fear decreases. Many people avoid investing or planning because they are afraid of making mistakes. Education reduces this fear by replacing the unknown with understanding. Even when outcomes are uncertain, informed individuals feel prepared. This readiness allows action, and action is what creates progress. Financial freedom is often misunderstood as unlimited wealth. In reality, it is about flexibility and security. It is the ability to make choices without constant financial pressure. Knowledge supports this by helping people align their resources with their priorities. Whether the goal is early retirement, meaningful work, or peace of mind, understanding money makes these outcomes achievable. Knowledge also influences how people earn money. It encourages investment in skills, businesses, and opportunities that produce long-term value rather than short-term income alone. This shift reduces reliance on time-based earnings and increases leverage. Over time, this creates more freedom with how time is spent. Teaching oneself about money is an act of responsibility. It acknowledges that financial outcomes are influenced by decisions, not just circumstances. While not everything can be controlled, understanding increases influence. This sense of agency is empowering. It replaces helplessness with intention and creates momentum toward independence. Knowledge compounds just like money. Each concept learned builds on the previous one, making future learning easier and more effective. Over time, this accumulation creates clarity and confidence. Financial freedom does not arrive suddenly. It is built gradually through understanding, application, and patience, where informed decisions shape outcomes and money becomes a tool that serves life rather than controls it.